Did you know that some investors live solely off dividends? In 2023, companies in the S&P 500 paid out a record $588 billion in dividends, up from $564.6 billion in 2022 and $511.2 billion in 2021, leaving many investors smiling to the bank. In this video, we tap into Warren Buffett's counsel on dividend investing to help you learn how you can start living off dividends comfortably. Let's get started. We kick things off by understanding the basics. What exactly are dividends? Dividends are a distribution of a portion of a company's earnings to its shareholders. When a company makes a profit, it can choose to reinvest that profit back into the business or distribute it to its shareholders in the form of dividends. Dividends are typically paid out regularly, often quarterly, although some companies may pay them annually or semi-annually. Dividends can be paid in cash, additional shares of stock, known as stock dividends, or other property, but in this video, we'll be focusing on the former. Now that we grasp the concept of dividends, let's talk about how to build a strong portfolio. Essentially, a portfolio is just a collection of investments, like stocks, bonds, or mutual funds. But building a portfolio isn't just about picking random investments and hoping for the best. It's about strategy and planning. When you're building your portfolio, think about diversification. This means spreading your investments across different sectors and industries. By diversifying, you're not putting all your eggs in one basket. If one sector takes a hit, you won't lose everything. It's like having a safety net for your investments. Another thing to consider is your investment horizon. Are you investing for the short term or the long term? Warren Buffett, a legendary investor, advises taking a long-term approach. This means thinking about your investments as a marathon, not a sprint. By taking a long-term view, you can ride out the ups and downs of the market and give your investments time to grow. Seasoned investors often seek refuge in defensive stocks that pay dividends reliably, especially in periods of elevated interest rates and ongoing earnings pressure. Warren Buffett, however, prioritizes companies boasting robust fundamentals and enduring competitive edges. These firms stand out for their resilience in maintaining and even enhancing dividends, irrespective of macroeconomic fluctuations. While many investors gravitate towards stocks with lofty dividend yields, Buffett advocates for those with more moderate yields, but hailing from financially sturdy and thriving enterprises. At the close of the second quarter in 2023, the majority of Buffett's portfolio comprised such companies known for their consistent history of dividend growth and payout. For Buffett, the true worth of any dividend stock lies in its capacity to generate earnings, not only in the present, but also in the foreseeable future. And you know what? Buffett's skillful stock picking for passive income is evident as Berkshire Hathaway is anticipated to accumulate over $6 billion in dividend income in 2024. How can you live off dividends? Achieving financial independence through dividends is a goal many investors strive for. With the right approach, dividends can provide a reliable stream of passive income, allowing individuals to support their lifestyle without the need for traditional employment. This requires careful planning, disciplined investing, and a focus on building a diversified portfolio of dividend-paying assets. Strategy 1. Blue-chip dividend stocks. Investing in blue-chip dividend stocks is a tried-and-true strategy for generating consistent income over the long term. Blue-chip stocks represent established companies with strong fundamentals, stable earnings, and a history of reliable dividend payments. These companies are often leaders in their respective industries, with recognizable brands and enduring competitive advantages. The appeal of blue-chip dividend stocks lies in their ability to provide a steady stream of income regardless of market conditions. These companies have weathered economic downturns, geopolitical uncertainties, and industry disruptions, consistently rewarding shareholders with dividends through thick and thin. By investing in a diversified portfolio of blue-chip stocks, investors can mitigate risk while capturing the benefits of dividend income. Furthermore, blue-chip dividend stocks offer the potential for capital appreciation over time. While dividends provide regular income, these companies may also experience stock price appreciation as their businesses grow and prosper. This dual benefit of income and growth makes blue-chip dividend stocks a cornerstone of many income-focused investment portfolios. Strategy 2. Dividend growth stocks. Dividend growth stocks represent another compelling opportunity for investors seeking to live off dividends. These companies not only pay dividends, but also have a track record of consistently increasing their dividend payouts year after year. By prioritizing dividend growth, these companies demonstrate financial strength, operational excellence, and a commitment to returning value to shareholders. Investing in dividend growth stocks offers several advantages. Firstly, these companies often operate in sectors with favorable long-term growth prospects, such as technology, healthcare, and consumer discretionary. By focusing on companies with strong fundamentals and growth potential, investors can position themselves to benefit from both dividend income and capital appreciation. Additionally, dividend growth stocks tend to exhibit lower volatility compared to non-dividend paying stocks. This can provide investors with greater stability and downside protection during periods of market turbulence. By building a diversified portfolio of dividend growth stocks, investors can create a resilient income stream that grows over time and supports their financial objectives. Strategy 3. Covered Call ETFs. Covered Call Exchange-Traded Funds, ETFs, offer a unique approach to generating income from dividends. These funds hold a portfolio of dividend-paying stocks while simultaneously selling call options on those stocks. By selling call options, the ETF generates additional income, which is distributed to investors as dividends. Covered call ETFs provide several benefits for income-focused investors. Firstly, they offer exposure to a diversified basket of dividend-paying stocks, reducing individual stock risk and enhancing income stability. Additionally, by selling call options, covered call ETFs can potentially improve overall returns, providing investors with a higher yield compared to traditional dividend investing alone. Moreover, covered call ETFs can serve as an effective risk management tool, providing downside protection during market downturns. By incorporating covered call ETFs into a well-diversified portfolio, investors can optimize their income generation while managing risk effectively. Living off dividends requires a disciplined investment approach and a focus on building a diversified portfolio of income-producing assets. By combining blue-chip dividend stocks, dividend growth stocks, and covered call ETFs, investors can create a robust income stream that supports their financial goals and aspirations. Now let's do some easy math to understand how you can make $4,400 each month. We'll compare two methods: covered call ETFs with a 12% yield and traditional dividend investing. To get $4,400 every month with covered call ETFs at a 12% annual yield, first, find out how much money you need yearly. If you want $4,400 per month for 12 months, that's $52,800 a year. Now, divide this annual income by the yield percentage, 12%, to find out how much you need to invest. So $52,800 divided by 12% equals $440,000. That's how much you need to invest in covered call ETFs to get $4,400 each month. Now, let's look at a traditional dividend investing method. Typically, blue-chip stocks offer around a 3% dividend yield. So if you want $4,400 every month, that's $52,800 yearly. Divide this by the yield percentage, 3%, to know the total investment needed. So $52,800 divided by 3% equals $1,760,000. You need to invest approximately $1,760,000 in traditional dividend stocks to get the same yearly income. So here's the bottom line from the math. If you want to make $4,400 monthly with covered call ETFs at a 12% yield, you'd need to invest $440,000. But for the same $4,400 a month with traditional dividend stocks at a 3% yield, you need to invest $1,760,000. Clearly, the traditional dividend method requires a much larger investment for the same income level compared to covered call ETFs with a 12% yield. Covered call ETFs offer a higher yield, which might attract investors looking to start with a smaller investment. But remember, covered call ETFs might not have much potential for capital growth like traditional dividend stocks. Also, consider diversification and your personal financial goals when choosing your investment strategy. It's smart to talk to a financial advisor to tailor your approach to your needs and risk tolerance. In short, whether you go for the power of covered call ETFs with a 12% yield or stick with traditional dividend investing, remember that building a dividend income is a marathon, not a sprint. Your choice should match your financial goals, risk tolerance, and how long you plan to invest. Both methods have their advantages, and the key is to be patient, stay informed, and keep investing. So which method do you prefer? Would you like to learn more about dividend investing strategies? Share your thoughts in the comments below. If you enjoyed the video, you'll love our other finance videos, so check them out. Remember to like, share, and subscribe.